Ever wondered how to turn just $100 into a growing investment? Many beginners think they need thousands to start, but that's not true. You can start small, learn as you go, and build wealth over time. Let's start with ETFs. ETF stands for Exchange Traded Fund. An ETF is like a basket of stocks. Instead of buying individual companies, you buy a small piece of many companies at once. This reduces risk and makes investing easier for beginners. For example, the SPDR S&P 500 ETF, ticker SPY, tracks 500 of the largest U.S. companies. One share costs about $664, but with fractional shares, you can buy part of a share with just $100. Historically, the S&P 500 has returned around 7% per year after inflation. That means if you invest $100 today, in 10 years, it could grow to about $200 without doing anything else. If you add $50 every month, it could grow to over $8,000 in 10 years. That's the power of compound interest. Compound interest means you earn money not just on your original investment, but also on the money your investment earns. Here's how you actually start. First, open an account on a platform like WealthSimple in Canada. Sign up, provide your basic information, and link your bank account. Once verified, search for SPY. Decide how much to invest. Even $100 gets you a fractional share. Click Buy, and you own a piece of 500 major companies instantly. Next, dividend-paying stocks. A dividend is money a company pays to shareholders, usually every 3 months. Companies like Coca-Cola, ticker KO, and Johnson Johnson, ticker J&J, have paid dividends for decades. You can buy a fractional share for $100. Coca-Cola's dividend yield is about 3%. That means if you invest $100, you earn roughly $3 per year, which you can reinvest to buy more shares. Reinvesting dividends accelerates your growth over time. For example, if you buy $100 of Coca-Cola and reinvest dividends, after 1 year, your dividends might buy an extra $3 worth of stock. After 10 years, reinvested dividends could contribute over $40 to your portfolio without adding any extra money. That's the magic of compounding. Robo-advisors are another beginner-friendly option. A robo-advisor is an app that invests your money automatically based on your goals and risk tolerance. WealthSimple lets you start with $100. It builds a diversified portfolio, handles rebalancing, and reinvests dividends for you. This way, you don't have to pick individual stocks or worry about timing the market. Now, here are 3 proven ways to invest your first $100. Quick reminder, this is not financial advice, just my opinion for educational purposes. First, ETFs. Buy a fractional share of SPY. Track it over time. Consider adding $50 or $100 monthly. This helps you learn how the stock market moves without risking too much. Second, dividend-paying stocks. Buy a small portion of Coca-Cola or Johnson Johnson. Reinvests dividends automatically. Over time, this adds up faster than most beginners expect. Third, robo-advisors. Start with $100 on WealthSimple. Set your risk level and automate contributions. This allows you to watch your money grow without stress. Many beginners make mistakes like chasing hot stocks, trying to time the market, or stopping investments when prices drop. Instead, focus on consistent investing. Invest regularly, stick to diversified ETFs or dividend stocks, and use automation where possible. Even $100 invested wisely can teach you valuable investing habits. Let's talk about real growth examples. Imagine a beginner invests $100 every month in a diversified portfolio averaging 7% annual return. After 10 years, the portfolio grows to over $16,000. After 20 years, it reaches over $40,000. After 30 years, it surpasses $100,000. This shows how small, consistent investments build significant wealth over time. Now, let's break down key terms for absolute beginners. ETF is a basket of stocks. Dividend is money paid to shareholders. Fractional shares let you buy part of a stock instead of a full share. Robo-advisors are apps that automate investing. Compound interest is earning interest on your money and the interest it already earned. Diversification means spreading your money across different assets to reduce risk. Rebalancing means adjusting your portfolio to maintain the right mix of investments over time. Next, let's look at real examples of beginners like you. A college student started investing $100 per month in an ETF portfolio at age 20. By age 30, their portfolio was over $20,000. They never invested more than $100 per month at first, but the habit of investing consistently and reinvesting dividends made the difference. Another example, a young professional invested $100 in Coca-Cola stock and $100 in Johnson & Johnson. By reinvesting dividends and adding $50 per month, their dividend income alone grew to over $100 per year in just 5 years. That's extra money that buys more shares automatically. Now let's go step by step through a beginner's full plan. Step 1. Pick one of the 3 methods: ETF, dividend stock, or robo-advisor. Step 2. Open your account. Step 3. Invest your first $100. Step 4. Set up automatic monthly contributions, even $25 or $50. Step 5. Track your growth and reinvest dividends if applicable. Step 6. Review your portfolio every 3 to 6 months to ensure your investments align with your goals. Even if the stock market goes up and down, don't panic. Volatility is normal. Over long periods, markets generally trend upwards. That's why consistency matters more than timing. Another tip for beginners: start learning about companies you know. Look at brands you use every day: Coca-Cola, Apple, Amazon. Research their performance, check if they pay dividends, and see if they fit your investment style. This makes investing less intimidating and more relatable. By now, you should understand how small investments can grow into meaningful portfolios. Starting with $100 teaches discipline, patience, and consistent habits. These are the real keys to building wealth. Finally, remember this: start now, no matter how small. Use ETFs, dividend stocks, or robo-advisors. Invest consistently, reinvest dividends, and track your growth. Time is your greatest ally in building wealth.